Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you. And before deciding to invest in foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading and seek advice from an independent financial advisor if you have any doubts. All right, guidelines for model testing for the pivoteers. The objective of this document was to help you manage risk conservatively. And we talked about data sets and holdout periods and out of sample periods. And we talked about building robust trading systems that are not dependent on not deviating from really slight adjustments. Then we talked about some important ratios that are involved in testing. The Sharpe ratio, the drawdown, the MAR ratio. And that brings us to segment number 3, which is our last and final segment, the risk management process. Kenrick is here with us again. Kenrick is the author of this document. Kenrick lives in London, worked for large trading firms, and spent a lot of time thinking very deeply about risk, and has generously shared his expertise and knowledge with us inside of this document. It may be the most important document that has ever been produced or published as a part of this course, and I would certainly ask you to spend some time thinking through it and coming to terms and grips with some of the realities. The risk management process includes identification, estimation, implementation, tracking. That's a process that's involved no matter what. I'll invite Kenrick during the webinar today to at times comment on or participate and elaborate on principles that are discussed within this document. He truly is the expert here, and I'm summarizing the words that he wrote, but they're not my own words. They really are his, and the credit goes to him, and the appreciation certainly goes to Kenrick. Risk management is meant to be a virtuous closed-loop process. In the first instance, we identify the types of risk that we potentially face, such as volatility, a risk-to-reward ratio, and a risk of ruin. This list is by no means exhaustive and merely provides a framework to manage our process. We then estimate our risk. In our case, we use history as a means of estimating our level of risk. Implementation is when we decide how we implement our model and the emphasis that we will place on the different measures to shape our strategy. Tracking is when we measure the actual outcome of the same risk measures that we implement and the contingency measures that we use. For instance, we might say that if the actual risk outcomes are worse, then we're going to stop trading the strategy until we either have a good explanation or we'll re-estimate other risk parameters that may be more applicable to our trading environment. So if you experience a number of losses in a row that are way outside the standard or something absolutely crazy, you might shut down the model. And if the risk outcomes are better than expected, if you have 10 or 15 winners in a row, or the winners are way bigger than the average winners are in general, then we might consider that we're not using our risk budget as efficiently as we could. I say that this is a closed loop process, as we will on an ongoing basis look at either other risk measures if relevant and continue to re-estimate and implement as necessary. And remember that risk management is a process that never stops. And keep in mind that there will always be new strategies that you want to trade, and this provides a way of adding it to your existing strategies. Remember that I'm never saying in this course, and I apologize for anything that says otherwise, I never said that, you shouldn't test or try new methods or build new things as they go. What I did say, however, is that first, lock down a method that you understand very clearly, the risk parameters and the reward parameters, and you know what to expect over time. Lock that down first and use a rigorous process of experimentation to make sure that you know what you're doing. That's what will give you confidence in trading the method. And then you could use that method to make some money as a research and development budget and then branch out to experimentation. But the process of adding trading systems for people simply comes down to sometimes just following what somebody else said, or it comes down to just switching what you're doing anytime that you're not happy. It's very difficult to move through this process and come to terms with your weaknesses and the weaknesses of your system, but it's worth going through this process. We've already discussed what the process is, and I see people in the group, unfortunately, saying, well, that's not even just saying it, but just kind of saying, oh, I either already did that, or that's not really what I'm going to focus on, or that's a lot of work, or I don't really understand the terminology. And what Kenrick's doing here is offering an idea for how you can really lock down a trading system and then move on to the next thing. Recently, I had a conversation with Kevin. I think Kevin's got a strategy that is borderline brilliant. I didn't understand it at first, but it's really good and it's really individual. Kevin's doing something that is truly individual and personal. I would put Dan in the same category, that he's really focused on something individual. Dan wakes up and knows what he should be doing. Keith is the same. Keith wakes up and knows what he should be doing. They are solid or on solid ground with respect to what they're doing. It's not perfect and it's not exactly where they want it to be, but it's good. And they're implementing it because it's good. They understand what the risks are. They know what their stop losses are. They know what their profit targets are. They know what the trades look like. They know how to identify them. And they're not looking to make giant changes, but if they can make improvements, they'd like to do that. This document provides a template for taking some improvements, testing them, and seeing if they improve things or not. That's a really good thing. Some of you, however, are at a point in your trading career where you really don't know what you should be doing and you're lost still. You're still lost. You're not happy with where you are. That's a problem. And you have until December 31st to make a change in that respect. And what you would do is you would choose a holdout period for data, a 2 or 3 year period of time perhaps, and you would start by perhaps testing the standard Wallaby trade with a certain profit target and a certain stop loss, and a certain risk to reward and a certain time of day that you would trade. And then you run through that holdout period and you say, wow, that turned out all right. Then you take a separate set of data and you call that the out of sample period, and you test those parameters that you just used. And then you start to answer questions. What's my drawdown? What's my Sharpe ratio? What's my MAR ratio? If I change things a bit and I go back in time and I make some adjustments, could those ratios improve? And then when you find something that works reasonably well, and it's not perfect, but it works reasonably well, you implement it, period. I think every single person here, with very few exceptions, already knows what they do well at. The problem comes when you get a few losses and you start to feel discombobulated, or you see other people trading something different and you follow along with what that other person is doing. And then you get off track and you find yourself way out of the loop of risk management and just randomly trading, just doing all kinds of different stuff all the time and saying that, well, so-and-so probably tested their method, so I probably could do that too. Well, I'm going to take that one with Kevin. I'm going to take that one with Rob. Or Ineki mentioned something really interesting. I'm going to follow that. And that's all random trading and doing all kinds of messed up stuff. What Kenrick's saying in this document, and what I am providing a secondary witness for, is that you should find something that you can be consistent on. And then you should hold yourself accountable to the group and to yourself to stay consistent on that method. This document helps you identify how to go about the process of finding something that you can be consistent on. And it gives you a risk management process. If you don't know what you should be doing, there's a way to do that. And this document and this webinar series has really been about helping you find what you should focus on. Kenrick, do you have any things that you'd like to mention? I'm going to pause for a moment, let some questions come in. And Kenrick, is there anything that you might want to mention here?
I think Rob, you said it eloquently. It was very little to add. I think the only thing.
What we want to do during this webinar series is set the tone for the future of working together as a group. If you imagine for a moment that the Pivoteers is actually a hedge fund, and that each of you is a trader in that hedge fund. What I'm asking for you to do, when you come into work every day, I don't want you to ask everybody at their desks what they're doing. I don't want you to look around the office and say who's trading what or who's getting into what trade and kind of jump around and say, oh man, that's interesting. Oh, I want to learn a little bit more about that or whatever. Because I hired you as a pivoteer, trained you to do some testing, trained you to look at the market in a certain way with a certain template. And then Kevin, who works over on the east wing of the office, took the Wallaby indicator and built something out of it and came back to me and said, what do you think of this? And I said, I think it's great. You run with that, Kevin. Here's here's what you can risk on that, and you go off and you trade that. And then I'm going to follow up with you, Kevin, and I'm going to ask you, are you doing the best you can with the system that you're supposed to be focusing on? And Kevin comes back and says, no, I'm not doing as well as I think I could. And I say, okay, Kevin, this is the place for you. This is the right company for you, because there's individuals here that we could work on a project to make some improvements to what you do. In the meantime, Kevin, I want you to continue making money from what you know how to do. Go back to work. And then Dan comes to me and says, Rob, I think I got off track, and I think I should be trading standard Wallaby divergence. And I'll go back over the parameters with Dan and say, Dan, what's your historical worst case scenario? What's your historical best case scenario here? I want you to go back to work, and I want you to focus on what you know how to do. I don't want you coming into work and looking over anybody's shoulder or following anybody else. I want you to do what you're supposed to be doing. Now, within this company, we have a style of trading. We use the Wallaby a lot. We use divergence quite a bit. We use retracements. We have Hector over here in the company that's inventing some stuff related to Hector pivot bias, and some people are in his group, and they're looking at that methodology together, and they're making improvements on that. But as a group, at the end of the day, you are individually considered, and you are individually, what would you call it? You are individually measured. I can't think of the word, but it doesn't really matter. I look at you as an individual and I say, are you on track? And are you individually responsible for what you do? You will be judged accordingly, and you will be held to a standard that you should come into work. And if you say, Rob, I don't know what I should be doing anymore, here's my answer. You need to go back to your desk, and you need to pull out the standard Wallaby, and you need to go back in time, and you need to wrap your head around trading the standard Wallaby, and you need to do some testing in a holdout period, and then a out of sample period, and you need to come back and tell me what your risk parameters are. And then we need to finish up by talking about the things that we're talking about today in this webinar. And you will be held responsible to do that as an individual. Although we all do something similar and we're all here together as a company, we don't all just do exactly the same trade every day. Now, some of you will in small groups. Some of you are over here trading standard Wallaby. Some of you are over here trading Hector pivot bias. Kevin's all the way over here trading the Kevin methodology, and Kevin would like to trade that with other people, but if that never happens, Kevin's going to make money, and Ineki's over here looking at some different things, and James is looking at some longer term trades. Kelly G is taking short term trades in the direction of the Hector pivot bias, and you're all responsible for reporting your performance and coming up with something solid that you say you're going to focus on. And you have support and encouragement from a large group of people, but at the end of the day, you are responsible for your own trading. All right, back to the point at hand. Data series for testing. In an ideal world, we would like a data series from the future, or at least one that resembles the future. If you knew that, there'd be no need to test, would there? However, as this is unknown, the best that we can hope for is to balance using the most recent period for testing, assuming that this is normal, while keeping in mind that we do not want to data mine or overfit the data, keeping honest with your testing. As an aside, if Kenrick and I could come up with a business that was able to use a variety of parameters from the market, news, market conditions, world affairs, volatility, options, open interest, and whatever else, and say that the future 3 months will most look like this historical 3 months, we'd be billionaires for producing that algorithm. The best that we can do right now is choose relatively recent data and essentially hope that relatively recent historical data will look like recent future data or upcoming future data. Of course, if we use data that's too far back in history, it's likely to be irrelevant and not necessarily reflective of the future. In this case, we're honest but have completed a wasted exercise. If you backtested your trading methodology on the pound dollar from 1995, your results would be different and probably not as useful as if you backtested using something within the last 5 years. It's simply the case that the market has changed over time. It's not that the system won't be profitable. It's that the volatility structure is different and the spreads were different way back then, and you would be really not honestly taking into account market conditions that exist now as opposed to back then. One way around this issue is to utilize a Monte Carlo simulation to create data that closely resembles the future. This is easier said than done. especially when we're dealing with high-frequency data such as tick or 1-minute data. There's too many effects to account for, such as time of day, well-known fundamental data releases such as NFP, etc. It's just like I said, if we could come up with a set of stuff coming up in the future and we could compare that to a set of stuff going on in the past and really build a model for what the future might look like, we'd be billionaires, not millionaires. And what some testers do is to utilize databases that have been cleaned up. There are some industrial sources of these databases, such as LIM for FX rates. Unlike other asset classes, though, the MCSI data is taken as one official source of equity data. There's no official source of historical FX data. Keep that in mind. Your testing might look different from someone else's testing because the data you're operating from is a little bit different because every broker is creating its own price feed. One view that you might take is that all data is dirty and live data will be dirty as it will reflect the bias of the particular broker given their positions and market conditions. For the pivoteers, we might begin work on cleaned up sets of historical data that we feel will be representative of the future. For instance, with the euro crisis looming, some of the data from 2008 might be more relevant for the market conditions that we'll face over the next year. Once again, it's the same concept that I mentioned a few minutes earlier. If we could look backward and find market conditions that were similar to what we think that we're in right now, we can theoretically maybe get ourselves a little bit closer. It's always really difficult to know if the future is going to look like the past. At a minimum, we can place more emphasis on this period of data and look to have cleaned up data from this period, paying attention to changes that may have occurred, such as trading spreads or risk on, risk off play and its effect on the US dollar. You could also look, Kenrick, at cycles of interest rate models, where interest rates had stayed low for a 2 or 3 year or 4 year period of time. They were generally at the end. What happens at peaks or valleys in the interest rate cycle? What does the data look like then? There's a variety of different things that we can combine, but what we're really trying to do is clean up data so that there are not large gaps in the data or missing days or times. And we're also trying to work with data that might be the most relevant, which is always a trick. But you can do at least a little bit of work to maybe try that out. Perhaps the idea of playing around with the historical data is too much for the retail trader given their limited resources. However, before you lose hope, spare a thought for an organization like CalPERS, that's the California Pension and Retirement System, that uses FX derivatives to ensure proper price execution given the size of their trades. Dirty data and variable spreads pale in comparison to these problems in execution, even when the institutional FX brokers will perversely pay to execute this type of business. What Kenrick's saying is that if you think your broker in the FX business on the retail side is dishonest, you haven't seen anything yet. There are multi-hundred-million-dollar lawsuits pending against major banks who executed trades at the end of the day or the beginning of the day based on the worst-case scenarios. There are stories about this in the Wall Street Journal that I won't elaborate, but you're not necessarily at a disadvantage compared to them. Mitigating risk through portfolio effects. We have up to this point decided on the risk measures that we'll implement, not only to guide our testing process, but utilize through implementation and model review when we trade live, the Sharpe ratio, the drawdown, the MAR ratio. As we mentioned before, risk cannot be avoided. However, it is our job to manage it the best we can. We will notice that individual currencies will have a certain level of risk, says Kenrick, that can be mitigated through combinations with other currency pairs. For example, we can combine, say, a Euro-CAD MCC trading model, trading one lots with a pound-dollar MCC model one lot. However, in time, you'll become familiar with many other dimensions to mitigate portfolio risk. Simply, portfolio risk is the combined risk of the two models that I just mentioned, meaning the risk that your portfolio is overextended in one direction or the other, in other words. The dimensions that we can attempt to mitigate portfolio risk are trading different currency pairs that are uncorrelated. Remember that the pound dollar is going to move in a similar direction as the euro dollar, and the euro yen and the pound yen are going to be the same. And if your only two currency pairs in your portfolio of trading are those two currency pairs, you're essentially just doubling your risk, or maybe magnifying it by a factor of 1.5, rather than just taking two different trades. If you really want to say, oh, take two different things, you might trade the US dollar Swedish kroner and the euro dollar Canadian dollar, which are different and maybe don't move in the same direction. You might vary the size of the trades for the various pairs to reflect that the value of each pip on each pair is different. You might combine one type of model with other approaches that are uncorrelated. You might combine MCC trading with a different sort of trading altogether. You might remove currency pairs that are adding too much marginal risk in relation to their marginal contribution to return. So you might say, you know what, I'm going to throw out the Aussie dollar because its returns are not really significant in exchange for, I'm taking the same amount of risk, but the returns aren't so great. You might also use mathematical algorithms such as mean variance optimizations to give some structure to your risk decisions. All of these are dimensions that come into a portfolio. So let's say that Connie, for example, runs through the process of backtesting the standard Wallaby on 3 different currency pairs. She tests the Euro CAD, she tests the, let's say, the New Zealand yen, and she backtests the Aussie dollar. Somewhat uncorrelated currencies. She backtests it, she gets her risk models in place, and she looks at the overall structure of it, and she says, you know what, I don't think I really needed to include the Aussie dollar because it's not adding anything to my model. And I think that I'm ready to go here. I'm trading different currency pairs, so if I take 2 trades at the same time, it's not likely to be essentially the same trade. And I think I'm ready to go here. That's what portfolio risk or judging portfolio risk is all about. All right, as we resume our discussion here, I want to remind you that take us back to the reason we're here in the first place. Take us back to the point for this entire document, which is a stretch for some people, but it's not too far of a stretch because we're explaining every concept as it comes. Here's what most people look at trading as. You're off exploring in regions unknown. It's adventurous, and your ship has torn sails, and massive amounts of gold or fortune await out into the future. You might change directions based on a new map that you find. And it's just an adventure every day. And what a lot of people do is they never get off of this ship, which never really gets them anywhere, only exposes them to danger, and they're willing to basically risk their lives or their entire trading account in exchange for maybe not so much of a reward. What we're talking about here is professionalizing your trading and asking you to not say, wow, the returns could be huge, or my gosh, I can't believe what could possibly happen. I mean, maybe the greatest thing ever could happen, and I could have an amazing run of 100 consecutive winning trades or something. What we're talking about when we say professionalize your trading is what Kenrick just mentioned, but he said it so quickly that you might have missed it. What we're saying is, we're going to turn it into a business where you understand the risks associated with your model, and you understand that you could have 2 or 3 losses this week, and it's no big deal because you lost a small amount. That there's no more giant variance or random trading all over the place, because every day when you wake up, based on what you have done to build the model in the first place, I keep mentioning it, the holdout period that you do your parameters in, the out of sample period that you double check it in, and then you live trade it to make sure it's working and functioning properly, and then you're improving it as you go. You did that process that took months at the beginning so that you know what you should be doing every day when you wake up. You're not on some wild adventure anymore. And if you have 2 or 3 losses or 2 weeks of losses, you don't really care. It doesn't matter because you understand the context. You're going to work every day, and that work that you do every day as a business is to go back to your desk and you implement your model, and in the afternoons after you're done trading your model, you're working on the improvement of your model. And in the middle of the month when you've reached your goal, I come over to your desk and I say, no more risk for you. You've gone a little bit above what your average returns are. We're going to shut you off, and we're going to ask you to start working on the improvement of your trading model a little bit today. And it's a business-like process where you have to decide what it is you're going to do. You're with a bunch of like-minded individuals that are focused on success. But at the end of the day, you have to sit at your own desk and you are pushing your buttons. And we are not randomly all over the place anymore. Every single person here can be specifically focused and not worried about what anybody else is doing. But you can trade what you're doing in conjunction with others. You can build what you're doing in conjunction with others. But then at the end of the day, Dan is sitting here running his trading side by side Keith, but they're not doing the same exact thing. And Keith had a negative week and Dan had a positive week. Last week, Dan had a pretty good week and Keith had a monster week. They're not doing exactly the same thing, but over time it's going to be fine for both of them, as long as they go to their desk every day and they stay consistent. Kenrick mentioned it just briefly, but it's so important. It's a business. I want you to wake up every day and I want you to go to work and I want you to implement your method. That goes for Dan, it goes for Keith, it goes for Gianluca, it goes for Hector. Hector's not trading right now because Hector doesn't know what it is that he's going to do when he goes to work. But if he were a member of the hedge fund, I would say, Hector, you're on a plan here and you have 4 more weeks to decide what it is you're going to focus on, and then I need to see you implementing it and making some money. And so Hector's on that plan. He's got a deadline and he knows that he's expected to trade. He knows he's expected to be profitable or at least consistent over time. That's the way it works. That's the way it's going to be. All right, here we go. Let's continue with our discussion. Mitigating risk through portfolio effects was our last section. We talked about the different dimensions of risk in a portfolio. If you're trading 2 different currency pairs, your 2 favorites, and they're exactly the same, you're just doubling up your risk. You should choose a different currency pair that might contribute something, but not just add more risk. It's a dimension of risk. Risk budgeting is my favorite section of the entire document, and here it goes. Up until now, up until this point, Kenrick has spoken about trade sizes, and although he has his own views on the subject, he'll defer to the conventional wisdom used by retail traders. If you've decided to risk 1% of your capital, then it's imperative that you're getting the best return for your capital. In plain English, you want a trade that has a high probability of success and also has a high level of return for your level of risk. Remember the Sharpe ratio? What is not necessarily thought through by retail traders are the choices for the efficient use of this risk budget. For example, I have a 1% risk budget with 2 trades that I can take. Do I take trade A or do I take trade B or some combination of the 2? Of course, the scientific answer on combinations was already given in the section above, mitigating risk through portfolio effects. However, if you have 2 different trade opportunities, it doesn't necessarily mean that you have to take both. You may choose to utilize your full risk budget on trade A. Assuming that you've done your analysis, testing, and live trading, it's important that you use your risk budget both consistently and fully. It doesn't mean that you always have to trade, but when you are trading and the trades that present themselves meet your criteria, then you have to trade them with your full risk budget. You can't be altering your risk willy-nilly. You have to have a consistent application of risk. Now, you might have different trade sizes for different types of trades, but those trade sizes need to stay consistent. We've all been there when we took the same trade size on a bunch of trades and then all of a sudden adjusted our trade size and things went haywire. For this reason, it's important that you review the performance of risk measures live versus the results on history, which Kenrick assumes that you are using to assist in risk budgeting. If your live trades are riskier than your budget risks, then you are exceeding your risk budget. Likewise, if your live trades are less risky than your budget risk, then you're not utilizing your risk budget efficiently. Many a money manager has been fired for this. To make this point again, if I expect a 2% return on a 1% level of risk, so if you're risking 1% of your account in exchange for a 2% gain, and the money manager is not fully using the risk, my returns are being compromised. And on the other hand, if I notice that I get a higher return, but my risk level is too high and possibly worse, when I look at the return, it's not usually commensurate for the level of risk taken, then you've got a problem. Meaning, if you are suddenly risking more than you used to, and you are achieving slightly better gains, you're in bad territory. So Kevin, when you look at the improvement of your model, and you look at the longer term trades, but if you find that you need to take more trades and you're having more losses, you might find that you're not necessarily improving your trading system by increasing the profit target. You may actually, over time, be causing problems for it. but you might be getting a psychological pat on the back because your rewards are bigger when they are rewards. It's just a cautionary measure. It's just to say that don't just assume that bigger profit targets are better. Don't just assume that a higher win percentage is better. Don't just assume that trading more currency pairs once you get one working is better. Choose one or two currency pairs and then just go to town on it. But don't necessarily open yourself up to lots and lots of different currency pairs or lots and lots of different things and think that it's better. Kendrick, do I state it correctly, or is it logical or valid to say that traders can sometimes say if I go for bigger wins, my trading system will improve. Or if I go for more wins, my trading system will improve. That the bigger picture actually has more to do. There's more to it than just that. Kenrick reminds us that this document is not exhaustive. It's not the only, or it's not the most comprehensive document on risk modeling or risk management that could ever be produced. And so he kind of spoke very modestly about the document. However, it's a giant leap forward from no consideration of risk modeling. And using this document to analyze your results and to consider what you should be trading is better than not doing it at all. And over time, this document expands, your understanding of risk expands, and your management of risk expands as well. And so it's a good place to start. It's a giant leap forward. And putting it all together is my second favorite part of the document. So what does this mean? I don't mean to just attach myself to Kevin or Keith or Dan when I keep speaking about them, but I am going to use them as examples during this final part of the document. Kelly, Dan, Kevin, I'm going to use you, and Hector, I'm going to speak of Hector as well. We've now discussed by a no means exhaustive list of comparators for our backtesting, and no single measure will provide all the information, and this information here will provide no guarantee of future performance. However, if we estimate and analyze these measures for our backtesting, we'll have a number of dimensions to differentiate between the models. And for example, these include when you finish a round of testing in a holdout period and an out of sample period, you can ask, what's the variability of returns? Meaning, go back into this document, watch the webinar that we did again, and answer that question. Are there wide swings in your annualized returns? I mean, based on what you've tested, could you have returns in a year that are negative 50 or positive 150%? That's pretty crazy, right? Do the returns look stable, or do we appear to make the most of the returns in one particular year? That would be a problem, right? Are we getting enough return for the level of risk that we're taking? Let me add a question in here. If you change variables only slightly, do you have massive variance in the returns? Can you stomach the drawdown that a particular model can experience? Let me just use an example here on the personal watch list. Keith, he had a bad week. I mean, I'd call that a bad week. If you worked for me as a trader, Keith, I would say that's a bad week. Yeah, we wanted it to be a winning week. But is it a bad week in general? In the overall perspective, does this matter? No. This probably fits very nicely into the overall plan that Keith has. The drawdown is acceptable, and Keith isn't going to change. Keith will start next week and do the same thing he did this week, and it could produce another negative 90 pip week. Keith isn't going to get fired from the hedge fund for this performance. He's not going to get promoted either, but he's not going to get fired for it, and eventually Keith is going to have another big week. And over time, what Keith is trying to do is have some stability with respect to his returns. He knows that maybe 2 to 3 weeks out of the month, he might lose 90, and then 1 week he could have a giant successful week. That's actually pretty stable. A lot of us lose hope in the short term when we see things go wrong. But the reason for that is we don't know what the bigger picture is. We don't know what the bigger picture on our trading system is. And so we don't know that we're supposed to just keep doing it. If you don't know that you're supposed to keep doing it, it's because you haven't done the testing that gives you the understanding of what you should be accomplishing here. For example, Hector's spent a lot of time working on the Hector pivot bias and the automation. Michael's done an extraordinary amount of work in coordination with Hector. Kenrick has provided some adult supervision with respect to risk. And I've watched from the sidelines for most of it as these individuals have done something really extraordinary. I've watched that same process occur in a different way with Kevin as Kevin built his own methodology. Both Hector and Kevin and Dan, who's trading standard Wallaby trades on MCC type things, all of them need to answer these questions before they trade. What's the variability of returns over time? Do the returns look stable? Are we getting enough return for the level of risk that we're taking? If you change things slightly, does the whole model blow up? Can we stomach the drawdown that a particular model can experience? If you can't answer those questions, then you haven't finished your process of testing. If you can't answer those questions, you're not ready to trade live. But if you can answer these questions, even generally, instead of saying what's the variability of returns, just tell me over the period of time that you traded in your testing, your holdout period for 2007, 2008, and 2009, what were the returns per month in every given month? If you can produce that in a spreadsheet, you can see a wide variety of returns. You can actually highlight all those months and you can produce a standard deviation calculation very easily. Or you could just look at those months and see that some months were up and some months were down. Do you know that about your trading system? Do the returns look stable, or do you go through huge long periods of drawdown with the testing that you did and then make all of your money in 1 year? That's a problem. Or if it's not a problem for you, you just start trading it and you realize that you could have a whole year that's a loser. Okay, that's fine. But you got to know that about your model. If you feel lost in the middle of a bunch of losses, it's because you're randomly trading back and forth and you don't really know what the system is supposed to do, so you don't know how it fits into the bigger picture. You have to also be able to ask, are you getting enough of return for the level of risk that you're taking? So if you go through a period like Keith went through this week of -90, you know why Keith is going to pick this up and do this next week again? Because he knows that there are some weeks that are really good. So the level of risk that he took this week and the losses that he experienced were worth it. He gets it. Dan knows that this positive week that he just had isn't going to necessarily be the case every week. So he cuts himself off at 75 pips because if it starts to go bad, he's just going to keep the losses down. And he's trading in a discretionary fashion. He's not automating it and running it 24 hours a day. And because he's not running it 24 hours a day, he's going to take what he can get and stop when things are good. That's a really nice way to do it. Remember that as a retail FX trader, you're in the business of managing risk. And that if you can find an alternative strategy that can provide the similar level of returns for a lower level of risk, then you're on the right path to achieving your risk management objectives. Consider that Kenrick didn't say if you can find a trading system that trades at a better time of the day for you, or if you can find a trading system that really does what you love, trading in the short term. We're not talking about what you love. And we don't give a crap about your sleep cycle. We don't care. We don't care that you like to sleep. We don't care that you like short-term trading. We don't care that you really wish that Jiminy Cricket would come down and teach you how to take trades that have a bigger profit target. We don't care. We care about your risk. If we find a methodology that has a reasonable and conservative risk and a particular return that is acceptable over that time, I'm telling you that as your pivoteer business manager, you're fired if you don't implement that model, even if it is inconvenient for you. It's time to grow up. If you need to do something in particular to manage your risk better and stay on track, and it requires a sacrifice that you are unwilling to make, then you have until December 31st to find a model that works, that can fit your lifestyle. But I'm not asking for the trading to fit your lifestyle. I'm asking you to change your lifestyle to better manage risk. Nobody goes to work at an investment bank and says, well, gee, boss, I really like short-term trading. Could we take the billion-dollar portfolio and do some short-term trading? Your boss, if you can't answer these questions, is going to kick you out of the office. And so would I. It's time for you to tell me by December 31st, what's the variability of your returns? Are your returns stable? Are you getting enough of a return for the risk that you're taking? Can you stomach the drawdowns? And can you be consistent? What will it take? One important aspect that many practitioners or traders ignore is to continually compare the actual experienced risk measures against those that we estimated from history and which we might consider as estimators of future risk measures. If our estimates were higher than expected, it's just as worrying as if we underestimated them in the first place. In fact, you could conceivably have employed a higher level of leverage in this case. To date, we think of our stop loss as a measure of risk, but we can now see how these measures can provide another dimension. The analogy would be if we continually budgeted for a 75 pip stop loss, when with a stop loss of 50 pips we could have taken 80% of our trades. We may come to the conclusion that the additional risk budget of 25 pips does not justify the returns, and risk budgeting is a topic that we'll explore further. I'll conclude this document with a special thanks and expression of gratitude to Kenrick. I invite all of you to make sure that Kenrick knows that you appreciate what he has done. Kenrick has pushed us forward, a giant leap forward in the professionalization of the trading that we do. Kenrick's not asking for you to judge him an expert or a god or anything else. Kenrick's not asking you to put the burden of your trading on his shoulders, and Kenrick's asking you to do your own work. Kenrick is absolutely asking you to follow a model for testing that helps you understand what your edge is or what your performance is. Answer the questions, is it really worth getting this return in exchange for what I have to go through? So that in the end, you could fill out a watch list and experience a week of losses or a week of gains and know how they fit into the larger picture. I've noticed that if I say the same things 700 times, someone will still ask it again. Doesn't anger me or annoy me. It might annoy some of you that already get it. But the only goal that you have between now and December 31st is to make sure that you know what you're doing every day when you go to work as a pivoteer. What you're trading, what that trading could produce given its historical risk parameters, so that when you go through a good time or a bad time, you understand how it fits into the bigger picture. And then you will be judged by your ability to stay consistent. Not judged on your ability to improve it, not judged on your ability to think of something great and new. If you want to work on something new, it can be after hours, after you have already done what you were supposed to do with the method that you already have. Some of you are still taking trades from other people's methods and mixing them in. Some of you are still saying, oh, I took that one over there because it was a whatever, but it's not really my main thing. Stop it. Stop doing that. Pick the method, pick the focus, pick the pairs that you want to pick, and understand what the risk parameters are on those. And if you have problems with it, let's talk about it. Let's talk about it consistently and regularly inside this forum, inside these webinars, inside the chat room, and let's get back on track and make sure that you're doing exactly what you need to be doing to do and achieve what you want to achieve by a certain date in time. Thank you very much again, Kenrick. I appreciate the document and the leading of the discussion that you did.